Good morning and welcome to Bloomberg Quint, India's first digital live streaming business news service. I'm Neeraj and you're watching Indian Open. Let's go straight to the headlines. SEBI makes it mandatory for large corporates to raise at least 25% of their borrowing from the corporate bond market from the next financial year. The new IIFL board claims it has received over a dozen offers for two subsidiaries, IIFL Securities Services and ISSL Settlement and Transaction Services. SMEs have faced the brunt of structural changes in the economy, according to Principal Economic Advisor Sanjeev Sanyal. He calls for lower rates and some support to overcome these disruptions. And Yes Bank promoter entities have repaid 400 crores raised against pledged shares to Reliance Mutual Fund and Franklin Templeton Mutual Fund, according to a PTI News report. I would say this would be in part courtesy to the story filed on Bloomberg Global and Bloomberg Quint over the weekend. However, let's take a look at the trade setup for the day today. The world markets were, well, not a bad place. At least the US markets were not a bad place. I think they did reasonably well for themselves and aided in part by the index on your screen, NASDAQ, up about 2%, because all the FANG companies, at least Amazon and some of the others in particular, went up in trade. I think that block of stocks which had corrected quite strongly over the last few days went up quite substantially. They got their bite back, literally and figuratively, and that led to NASDAQ doing really well and thereby the other companies doing well. By the way, GM was the other prominent part out there. It may be in the eye of a storm with the politicians, but GM as a stock too did very well. So the US markets ended fairly decently, and that's had a bit of a ripple effect into select Asian markets. So if you look at what the rest of the Asian pack is doing, Nikkei is doing well, Shanghai is doing well, Hang Seng is not. SGX Nifty is indicating a bit of a downside, but keep in mind, SGX Nifty, unlike some of the other Asian peers, had a big, or the Nifty, unlike some of the other Asian peers, had a bit of a rally in trade yesterday. So likely to start off 0.25% to 0.5% lower in the session today. However, it's expiry week. I don't quite know if there will be big gyrations ahead of Thursday. Frankly, if you look at the call put position, that all seems to be changing every single day. In yesterday's session, it was still 10,000, 10,700. Today, the max OI for the November series, and now we'll start looking at the December series. Yes, the max OI for the November series on the call side at 11,000, the max OI for the put side at 10,500, and FIs bought in marginally in trade yesterday. DIs continued to buy about 352 odd crores. So it was all okay despite the fact that the market breadth wasn't the most positive for our markets. However, yesterday, I think two telling sectors stood out. One was what the private banks did, and which was great. Two was what FMCG did in trade yesterday. Remarkable pullback for a bunch of these FMCG names in trade yesterday. 2.36% and delivery-based buying seen in a bunch of these FMCG names in trade yesterday. HUL is a case in point. Look at that. The volumes, that chart will come up, and the volumes for HUL were the highest in a really long time, at least a month that we've seen the volumes on HUL move up, and compared to the 20-day averages as well. HUL, Dabur, Colgate, the volumes were substantially higher, and the delivery-based buying was seen, especially in names like HUL and Colgate. So there's some serious buying seen in these names. The question mark only is whether this can continue into today's session or no, because there was some smart moves out there. Colgate was up 4.5. Dabur was up about 4.5. HUL was up about 4% at a point of time. So FMCG names had a bit of a rally already. Let's see if this can last. So banks and FMCG saved the day for us yesterday. Let's see what they do in today's session. However, that is for us to know once the market closes. What will happen on market open? Those 4 or 5 names that I think we should keep an eye out for in today's session. Now, NIT Technologies, Bloomberg News reports that promoters are exploring options to sell stake in the company. This was widely reported by another business news channel, I believe ET Now, during the course of the day yesterday itself, but this should be an important stock to monitor in the session today. Small name now, Bharat Ventures, small piece of news. They signed a contract with Tata Power for a power supply of 120 megawatts at a rate of 5.75 per unit. Let's see if this brings about some reactions into Now Bharat or no. Unichem could be an interesting one. They received an EIR for post-marketing adverse drug experience inspection by the US FDA. I think the long and short of this seems to be that there's a closure of inspection which started from June 25th to June 29 for Unichem Labs. But I thought what was really important was what came in from the brokerage side on two key names. Firstly, Bank of America Merrill Lynch on Reliance Industries. They, in that report, which is exceedingly bullish, I use that term carefully, exceedingly bullish, they make some telling points. One, about whether Reliance Industries, and according to them they crossed the tipping point in consumer acceptability, and the shift from B2C to B2C from B2B will help valuations. A 29% upside potential. They raised the target price by 11% to 1430 from 1280. More importantly, I think that whole thesis that they're questioning about whether retail and Jio would lead to Reliance's acceptability as a B2C company, and therefore does that give it premium valuations than what it enjoys right now. It's an interesting point to ponder over the course of the next few months. Let's see if Reliance Industries has a bit of a reaction on this note in the session today, because there's a stiff upside target out there too. And Macquarie on HEG, again, the buyback got announced yesterday, but I think the note seems to suggest that if there were concerns on capital allocation, this buyback does put that to rest. They maintained the outperform, the target price at 5823. The stock didn't react materially yesterday. Let's see if there's a bit of a reaction in today's session on HEG. So these are 4 or 5 names that I thought from amongst the large and liquid names are the important ones. We'll talk a lot more about some of the others too. However, let's tell you what's lined up on First Word today. It's the collection of the top editorial stories that we believe we should bring to you. Sajid Manga Johnson to explain what SEBI's new borrowing norms mean for large corporates and the debt market. Petrol and diesel prices in India have not kept pace with crude prices fall. Amit Sarkar will tell us why. Mahindra and Mahindra may be losing some ground in the tractor market. Yatin Mota will map the market share picture for the tractor companies. And the crack in metal companies yesterday, we look at what could have been the cause and what do valuations suggest, if anything, and what did brokerage is saying about that. I'll weigh in on that for a bit. But first, the important piece of news, and let's bring that up on the screen. Sajid Mangat should be joining us in moments from now, and we'll talk about that too. And then we'll talk about what some of the metal companies could do as well. But let's start off with oil and gas, and that's an important piece to monitor too. 2 or 3 things that we'll talk about today on First Word. But let's start off. Is Sajid here? Should we start with Sajid? Then we can start off with Sajid, because the regulator has notified norms making it mandatory for large corporates to raise at least 25% of its long-term borrowing from the debt markets. The rules come into effect from the next financial year. Any corporate with borrowings of more than 100 crores, excluding funds raised via ECBs and interpromotorial group companies, will fall under this category. Confused? Let's get in Sajid to simplify this for us. Sajid, good morning.
Okay, let me put it in perspective. If you look at the total outstanding bonds, corporate bonds in the market as of September 2018, it's somewhere around 28.38 lakh crores. That's the total market of outstanding bonds, and that the outstanding instruments is around 24,000 instruments which are there as of September 2018. Of that, if you look at based on how much money was raised last year, that is FY18, that was around 6 lakh crores was raised through corporate bonds. Now, if you go by the SEBI papers, it very clearly states that corporate borrowings can be broken down into 2 halves, bank borrowing and bond borrowing. And in FY17, that's the latest data, 51% of the total borrowing was through bond borrowings. So for the first time in FY17, bond borrowings overtook bank borrowings. So you're looking at roughly around, and FY17-18 was another period where bank borrowing was much more subdued because a lot of banks were going to stress. So this proportion would have gone up further. So roughly we are talking about a borrowing market of 12 to 13 lakh crores from the point of view of the what the corpus of this is. What SEBI is now saying is that you need to any corporate which is a large corporate entity, and they've defined it very clearly that in the previous financial year, if they have a long-term borrowing of more than 100 crores and they have a borrowing program for the next financial year, then they have to put nearly 25% of that borrowing through corporate through the debt market, which basically means that you have to mandatorily come to the debt market and list your debt. That brings in little bit of transparency as far as the market is concerned, and at the same time, it expands the market in growing. This includes all refinancings which companies are doing, but excludes certain classes of of borrowings, which is like ECBs or intercorporate borrowings between parent and subsidiaries, which normally happens. So if you exclude that and then you have a long-term borrowing of 100 crores, then you become a large corporate entity. You are classified as one, and it's applicable from 1st April 2019 for companies whose financial year is ending on March 31st, and 1st January 2020 for companies whose financial year is ending on December 31st. There is a penalty clause, or what you can call it the penalization, which is there in case if you don't meet these for 2 consecutive years, then 2.2% of the total outstanding amount which you were supposed to come to the bond market but you didn't come, that's the kind of penalty which you have to pay to the stock exchanges, and the stock exchanges pay to the SEBI's Investor Protection and Education Fund, which happens there. There are a couple of issues here in this. One is that nearly 99% of the total borrowings which corporate did was through private placement, and public was hardly a percentage. 99.1 or 2% was private placement which was there. Of the total corporate borrowings, private companies and non-financial companies, means you remove the financials from there, that's totaling to nearly 21% odd. So it's a very small percentage of private companies who are coming to the bond market, and this is what SEBI is trying to bring in, saying that more private companies should come in and and borrow from the market there. The issues here is that as far as financial services companies are concerned, they are not supposed to put a debenture reserve, redemption reserve. What happens is that for private companies, they have to put a part of the profit amounting to equivalent of 25% of the debentures they hold in a debenture redemption reserve.
DRR, yeah.
And they also have the stipulation of putting 15% of the debentures coming up for maturity in a year in bank deposit or government securities there. So that takes away the opportunity cost for private companies, because you're putting the entire cash which can be used further into redemption. The argument which SEBI has also made in its paper is that now that you have a robust IBC process in place, that requirement should be done away with, and so that if anyone defaults, this will ensure, IBC process may ensure that there is a resolution which is in place there. The budget spoke about, if you look at Jaitley's budget of 2018, the budget said very categorically that a credit rating of up to A can be brought into the market. But what SEBI has done is, initially they have brought in AA and above, and as the feedback comes in, they will bring down the rating to A as well, and that will bring in more smaller corporates. But a large, nearly 90% of the borrowings that happen in the market is AA and above. So it's only a small marginal ones which is A credit rating, which is not available as of now for this market, or is not eligible for that. So in a nutshell, you'll have a lot of corporates now complaining that their flexibility of raising funds, however it may be, means through bank borrowings or their overseas or other stuff, private placement, etc., gets curtailed because they have to meet this 25% thing. And some of the companies have been vocal about it, but point is that many of the companies are already coming to the bond market because bank credit was not available for in the last 2 years. So it's a question of whether they come voluntarily or they've been pushed to the bond markets.
Well, we've spoken at length, Sajid, over the last few years about the need for a deeper bond market as well. Maybe this is one such step which enables that. I'm not saying that's the reason why this is being done, but this could have ramifications there as well.
Yeah, it is. You look at the entire ILNFS issue and other issues which happened in September, October, November, right? We are seeing a deeper connect which is happening between the bond markets and the equity markets here, because there is they are taking a cue from the credit market on the quality of, and credit market takes a faster cue than equity markets
around the world,
all over the world, and we are seeing those trends happening here. So it's good that you have a interconnect which is happening between credit and equity market. The only issue was till now that the transfer of information was asymmetric, it was because of private placement. We never used to never used to know.
Yeah.
We used to hear of no rumors in the market. Oh, there's a default. There's no interest payment or something.
Now it will be public information.
Now it will be public information, and
Sure.
there's much more clear, information flow which goes through the through both the markets actually.
Let's wait and watch. This happens sooner rather than later. Sajid
But
Bhagat,
it's a good business opportunity for credit rating agencies.
Oh yeah, well, that's an important market to look at as well.
Yes.
So I think thanks for putting that into perspective. Maybe tomorrow in First Word, we'll talk about what would happen to some of the credit rating agencies over the course of the next 3 or 4 years. Till now, those stocks have been wealth destroyers of sorts. Could things change around? Sajid, thanks for putting that into perspective. So that'll come up on tomorrow's First Word, I assure you that. Okay, the next piece on today's First Word is about oil prices having dropped over 30% from the October peak, but consumers continue to pay a high price for fuel in India. Not that oil marketing companies have not cut petrol and diesel prices at all, just that the reduction has not kept pace with crude. I know a lot of people on social media talk about why is it that crude having fallen so much, we continue to pay as much. Well, Samit Sarkar has the answers. Samit, bring us the math.
So if you see, they have the main reason behind why the crude prices haven't fallen in tandem with the Brent crude prices, that is because they have been ramping up their gross marketing margins. In fact, the margins that they earned yesterday were at an all-time high for the oil marketing companies, and that is because the retail fuel prices have not fallen in tandem with the Brent crude prices. So if you see, since its peak, Brent crude has fallen nearly 30%, while the retail petrol and diesel prices have fallen only 11% and 8% respectively. Now, one would argue saying that the oil refiners consider the trailing 15-day average prices of crude as cost, plus there is the rupee impact, plus there's freight cost impact, which also needs to be accounted for, which is a fair argument. So to rule out these arguments, what we did was we compared the cost incurred by an oil refiner to convert every barrel of crude into fuel in rupees per liter. So this not only takes care of the 15-day average price, but also the rupee impact and the freight cost impact that the oil refiner has. So now when we compare the crude conversion cost in rupees per liter, we see that the peak prices of crude conversion was on October 15th, and this compared to the prices prevailing yesterday show us that though crude conversion costs for petrol and diesel have fallen nearly 27% and 18% from October 15th, the fuel prices charged to consumers have fallen only 10% and 8% during the same time period. Now the main reason behind this is the increase in the markups, that is the gross marketing margins. On petrol, the gross marketing margins have jumped nearly 8 times, while on diesel it has increased nearly 3 times from what they were earning on October 15th. Now this clearly shows that the oil marketing companies have been trying to recoup their losses in the marketing business incurred earlier due to rising fuel prices and because of the changing government policies. Now so far in the month of November, if you see, the gross marketing margins that the oil marketing companies have earned is averaged around 4.7 rupees and 3.4 rupees on petrol and diesel, which is the highest at least since April 2016. And if crude prices continue to remain at these levels, this could further increase for the oil marketing companies going forward.
Have valuations played a bit of a catch-up, Samit?
Well, if you see the valuations for all the 3 oil marketing companies, they are still trading below their 5-year averages. Now, this is despite a sharp rise in marketing margins, which was one of the main concerns in this drop in this valuations. But still, they are trading below their averages, which could be because of 3 possible reasons. Well, first could be because of the upcoming election season, which again raises the question on sustainability of these margins going forward. Second would be because of the changing government policies. The investor confidence has also been marred on the oil marketing companies, and third could be the potential inventory loss that the third could be the potential inventory loss that these oil marketing companies would see in the third quarter of financial year 2019 because of this sharp fall in crude oil prices, and this could be the 3 possible reasons why they're still trading below their 5-year averages.
Okay, Samit, just one quick question. I remember a conversation with the IDFC analyst saying that at 220, 230, the prices were discounting marketing margins to be zero till perpetuity. The prices have just come up a little bit in trade. Are analysts saying that there could be some more upsides if crude prices stay lower at these levels?
Well, analysts have also not changed their stance because they also question the sustainability of these margins going forward, given the fact that we have an election period coming in. And that's the reason analysts have also not changed their stance on the company.
Okay, let's wait and watch if it turns around or no. But Samit, thanks for putting that into perspective. Some answers to really some burning questions in the minds of a lot of not just investors, but almost everybody who goes to the fuel station. Yatin, you've been talking about how we're paying higher fuel prices. Well, there you have your answers. But let's talk about the third piece on First Word, and that's about tractors. And you know, Mahindra & Mahindra has been the mainstay for some time now. But are things looking like They are changing because there are a slew of new products, higher crop prices, and ample rainfall have increased sales for not just M&M but for a lot of others.
So, Neeraj, yesterday we had a Kotak report coming in, and more importantly, the Tractor Manufacturing Association data coming in. That data is the regional data, which really talks about the aspects of how really are the key states shaping up in terms of demand. Now, if you look at the Indian picture, the demand has been seen declining, in various states and rising in certain states. And let's start with the above average, boys. Haryana, Gujarat, and Uttar Pradesh. These are the few markets which have done extremely well in the last, 7-8 months. Especially, we are talking about the FY19 period so far. However, key markets like Maharashtra and Gujarat have seen overall decline, coming in as far as the overall tractor demand is concerned. And remember, Maharashtra and Gujarat are very large markets wherein we have seen muted demand trends. So clearly the northern markets look promising as far as the entire tractor data is concerned. And remember, Neeraj, we had the management of Escorts talking about as to how they are maintaining the guidance. However, we had M&M which said that they will be maintaining guidance but with a downward bias. Clearly these are the clear factors wherein the companies are also appraised at with these facts. Now, if you look at the breakup of sales, how really are sales coming up? For FY19 so far, we have the northern markets which have contributed to nearly 34% of tractor sales. The remainder of the markets, which is the west market, again an important market, 16% sales coming from there. East and south, again 18% each is the kind of contribution that we have seen. Central markets have been muted, 14% contribution coming in there as far as the TMA data is concerned. However, the key trends according to Kotak is that Mahindra & Mahindra has lost share. So if you look at the TMA data, we have seen that John Deere and New Holland, these are the two brands which have seen traction in the southern markets, wherein M&M has lost nearly 400 basis points of market share. Of course, the exact reasons are not shared, but the loss in market share is except in the 30 to 40 horsepower segment. So clearly in the key segments, M&M has lost market share. However, in the north and the west market, we have seen a good amount of traction coming in for Mahindra & Mahindra. So the south market, Mahindra & Mahindra is more or less stable as far as other markets are concerned, because they have been able to maintain the overall momentum in various markets. However, if you look at the pockets of growth, M&M has gained market share for Andhra Pradesh, Bihar, Haryana, Gujarat, Punjab. So Haryana, Punjab, which are the highly mechanized farmers in India, there M&M has been able to make inroads and they have been able to gain some bit of market share. However, the key factors, and according to the M&M management also, we have seen the crop prices weaken a bit in the marketplace, because of which there could be some impact on farm income. And more importantly, there has been a drop recorded in reservoir levels. And according to the Ministry of Water Resources, we have seen a drop in water resources, and which is the lowest this year. So for the month of November 15, the week ended, the reservoir levels have seen a deficiency of 3%. So that is something that we'll be keeping in a watch on, because of various drought related issues and lower than expected or subnormal monsoon. We have seen the reservoir levels take a dip, and that could have some adverse effect as far as the entire farm and tractor demand is concerned. So let's watch out for these two factors. One is the crop prices, and the second one is the water levels.
Yeah, I'll be interested, Yatin, in figuring out what the reasons are as to why in a relatively small market, but M&M has ceded some market share as well to some newer players. So should be interesting stuff. But thanks for putting that into perspective, Yatin. That's Yatin Mota bringing us the details of what the relative market shares have been for the tractor companies. M&M has ceded some market share to select players. The last piece on First World is about a sector that fell quite a bit yesterday. Indian metal stocks have lost a lot of sheen over the last few days, maybe over the last few months as well, with some of the heavyweights trading at respective discounts to 52-week lows on the valuation basis. So what are the factors at play? Well, let's bring up 2 or 3, and I've borrowed intelligence from some brokerages and from Bloomberg Intelligence as well out here. Firstly, the crack that we saw in yesterday's session for a Tata Steel, a Vedanta, Hindalco, essentially the entire clutch of stocks was under stress in trade yesterday. And frankly, for a company company like Tata Steel or some of the others over the last, or YTD, they've lost about, I think 22 odd percent. So the steel companies have come off quite a bit. This year performance, Vedanta is down 40%, Hindalco 20%, Tata Steel 27%. So the steel companies have come off. Now I'm talking about steel in particular and not necessarily the entire space. But look at what happened yesterday. When we highlighted this chart in Countdown 2, that rebar prices came off. They're stable right now. They've stabilized a little bit today, this morning. But the steel rebar prices have corrected and corrected quite significantly over the last couple of months at least. And that's prompted, one, an immediate reaction into what could happen to steel companies, but two, also prompted a clutch of brokerages. And I'm only using Morgan Stanley out here as an example because it's a fresh note. I was looking at 3 or 4 notes over the last couple of days, and everybody's talking about one factor or the other that could bring about some correction in the steel companies, and that has come about. So let me bring up what Morgan Stanley is saying with their assessment of the risk for the large steel companies. They're saying that the risk reward looks unfavorable because Indian steel companies' profitability has decadal highs and valuations are at a premium to history. So they are probably pricing in the best of both worlds, and that's why the risk reward does become unfavorable. They do believe that there is an additional risk of the domestic demand undershooting the first half demand in the second half, which means that October to March of the current financial year, the demand might be a lot lower than the demand numbers that we saw in the first half, which is April to September. So there is a demand risk, there is a valuation risk, and there is a price risk according to Morgan Stanley. Something that is concurrent with almost all brokerages, ICICI Securities, Morgan Stanley, and some of the others, and I think management conversations have said this as well, is a high leverage for the Indian steel companies. The net leverage is 1 to 1.2 times range, and the net debt to EBITDA is about 2.7 to 4 times for almost all of the steel companies. Now remember, yesterday when we were talking to the JSPL management, and while they were talking about the power business, but they spoke about JSPL as a whole, that companies are so leveraged that they didn't believe that there will be substantial expansion plans that will come in for the power companies. And we've seen a couple of steel companies say to that effect as well. There won't be fresh capex. If at all the capex is via resolution that happens in NCLT, and some of these assets will come into their fold. That's the extent of capex that will be done. So leverage certainly a concern for almost all brokerages. Now, frankly, there are 2 questions to ask. One, all of this is in the price, or could there be some more downside? I think that will depend on the winter production cuts coming from China and the sentiment thereof. But valuations have come off a bit. I mean, naturally with the price coming off, valuations have come off a bit. So if you look at the EV EBITDA numbers for a Tata Steel or a JSW Steel, and those charts will come up on your screen, this is from Bloomberg, you will see that how the estimated EV EBITDA for Tata Steel, which was trading at substantial highs for better part of 2017, in late 2018 has come off. Even for JSW, while it was largely trending upwards, it has stabilized a bit in the second half. JSPL too, the chart might not be here, but JSPL, because it's a combined business of sorts, but JSPL EV EBITDA too has shrunk a little bit. And frankly, if you look at any of these EV EBITDA numbers, or at least most of these EV EBITDA numbers, they are trading at either standard deviation or one level below standard deviation. So there's been a bit of a valuation correction already. The question mark to ask only is that if there is a further fall of another 5% in the steel companies, does that make the risk reward favorable for the companies after the kind of fall that we've already seen in this space? Time will tell, but for now, a lot of brokerages are citing concerns about valuations and the leverage on the balance sheet that the Indian steel companies have. Maybe that's why the stocks corrected a bit in yesterday's session and over the last few days. That brings us to the end of First Word, but we extend the analysis on metals with Rakesh Arora of Go India Advisors, who joins us a bit later on at about 9:45. But after this break, a full tilt towards the day's trade. Stay tuned to Bloomberg Pen Live.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually strive for it.
It's about the brightest ideas and cleverest implementations. It's about innovation.
It's about impact for manufacturers and help for shoppers. Tangible, meaningful impact for manufacturers who innovate, and genuine help for shoppers looking for the best new things on the shelves.
It's not about the award. It is about standing out. It's about being a giant even if you're really, really small. It's about picking the leaders of tomorrow, today. It's not about the award. It's about competing.
It's about an unbiased, countrywide, face-to-face consumer survey that is unique and provides relevance and differentiation. Essentially, we're adding something to the marketing arsenal of product teams.
It's about doing one's best and raising the bar each time.
So it's about the end customer. If you have that clarity, what is this need that you're trying to solve for the end customer?
About exceeding expectations. About going all in. Coming. Product of the Year.
It's about feeling good that we are associated with Product of the Year. This is our 10th year.
30 years of finding brands that capture $1 billion.
भाइयों बहनों, केंद्र सरकार राज्य सरकार मिलकर के काम कर रहे हैं।
किसान है हिंदुस्तान का, उसको सही एमएसपी मिलेगी। मुझे बताइए सही दाम मिल रहा है आपको?
मैं पूछना चाहता हूं क्यों चुनाव आगे कराया?
My relationship with Mizoram is a family relationship. It's a relationship of love.
अभी तो सपने और बड़े हैं, मंजिल काफी ऊंची रखी हुई है, वहां तक हम सबको पहुंचना है।
Welcome back. You're watching Indian Open right here on Bloomberg Quint. Let's go across and see what's happening in Asia. US markets fare relatively okay. You had the FANG stocks gain closer to 1% after a decline of 3.5% plus in last week's trade. So some amount of excitement coming back into some of those tech stocks. Asia is a pack, mixed bag right now. Shanghai up about 0.5%, Hang Seng down closer to 1/3%, with the Nikkei trading flattish. For the SGX Nifty, quickly pulling that up, we're seeing a dip of about 0.5% coming in post yesterday's big bang move of almost 100 points higher on the Nifty. We're giving back some, at least in terms of the indication of the SGX Nifty. Well, the futures and options side and what happened thereof, it was a really big move, and whether that culminated into some fresh positions and fresh longs in the system, let's ask Darshan Mehta. He's joining in right now. Darshan, good morning.
Good morning, Devina. And yes, there was short covering that was seen on the Nifty and fresh buying on the Nifty Bank. But the SGX Nifty is indicating that we will pretty much open below the 10,600 mark in trade. So open interest was down 3% on the Nifty, and the index was up close to 100 points. The Nifty Bank's open interest built up of 13%, that too on the long side. Now, where are positions being taken? We are currently at the 10,600 level. Put writers are active from 10,600 to lower levels, and call writers from 10,600 to higher levels. So pretty much we are in a broad range, narrow range between 10,500 to 10,700. What happened in trade yesterday? Since the Nifty had a move of almost 100 points, you saw that put writers became active from 10,400 to 10,600, and call writers were forced to shed positions at higher levels. So that's the trend that we are seeing at this point of time. As far as the stocks in the F&O band is concerned, firstly, let's talk about the PCR. The Nifty Pcr moved up, the Nifty Bank PCR coming in above the 1 level mark in trade. The 4 stocks in the F&O band remain: Adani Twins, Adani Enterprises, Adani Power, Jet Airways and Dewan Housing. All of them remain in the F&O band. As far as stocks that moved on open interest build up, so fresh short positions were taken on ACC, high open interest build up of almost 9%. You had fresh short positions again taken on Indian Oil, while Axis, Bata and Asian Paints saw fresh buying on decent open interest build up that you saw. In terms of stocks which saw long unwinding or short covering, you had Pidilite which saw long unwinding that came in, and you had Ramco Cements which you had long unwinding. The others saw short covering that came in into themselves.
All right, Darshan, thanks very much for that. That's the F&O wrap out and the setup as we move into expiry tomorrow. So it's going to be an interesting watch out. Mayuresh Joshi, fund manager at Angel Broking, is joining us on the show right now. Mayuresh, good morning to you and thanks very much for taking out the time. Let's start off with yesterday's move. The start to the week was a very encouraging one. I don't know if that will last through the week, and it's going to be a crucial expiry day as well. What's your sense in terms of the kind of positions that we've been seeing and the advice to investors right now?
So morning, Davina. No, I think a large element of what we've probably seen in terms of the market move is probably based on the premise of how the political outcome might actually turn out to be over the next few weeks. So I think in that sense, the markets is probably being a lot more buoyant at this point of time. But again, I think that's an event where the element of risk probably still lingers on. So I think if the result is contrary to what the markets is believing at this point of time, you might see just a little bit of a sentimental shake-off that might happen on the market. So I think that is one risk that is obviously from a near-term perspective that's lingering onto the markets. But I think the medium to longer-term view obviously is going to stay on how the earnings are probably going to pan out. So the way the earnings have been in Q2 and the expectations again largely of improvement expected in the coming fiscal and the year after that, I think the penciling in of a reasonable amount of earnings growth to the tune of 11-12% is not ruled out. Again, private capex is coming gradually back in selective sectors. So as that starts coming through and as bank credit starts improving, my own sense is that you are probably going to see the traction that one really expects as a base case for corporate earnings to grow actually create a huge amount of base effect for the markets. So the volatility, in my opinion, can very well continue from a short-term perspective. But again, I think any significant decline or the volatility that gives a chance to enter into qualitative stocks is something that I'll be looking forward to.
Mayuresh, have you been observing what's been happening to most of these metal counters and the pressures that's been building around most of the names? Yesterday's session particularly saw a heavy cut in most of the steel names in particular. The likelihood of this pressure lasting probably till the start of the next year is something that most analysts are factoring in.
Well, it is quite a possibility, Devin. And again, I think if you're probably talking about how the international scenario is panning at this point of time, you're probably looking at what kind of an outcome does the US-China trade war actually have on these commodity-driven stocks. The second element obviously is how the pricing element stays. And again, I think there have been reports that China has been a little bit loose in terms of how the output might pan out over the next few months. And though you're entering into the winter season for the Chinese market, what really happens in terms of the LME pricing is going to be important. So if you look at the Chinese pricing, both the rebar prices as well as what is happening to HRC and CRC prices, they have come off from their highs. But at the same time, if you look at the inventory counts are not that high. So again, I think it's a matter of time that the readjustment probably happens in terms of the pricing scenario. On the domestic front, I think the prices have held up pretty strongly, both in terms of the tariffs imposed, specifically from countries outside India. And again, I think the kind of expectations that one really has in terms of demand dynamics actually remaining very, very strong. I think that has given the kind of impetus that we're probably seeing both in terms of realizations And though input costs have moved higher in the quarter gone by, I think the element of pass-through has ensured that the EBITDA per ton actually gets maintained for these companies. Again, I think a lot of these companies are getting into value-added products where I think the margins are relatively better compared to your standard structured steel output that these companies used to produce earlier. Having said that, on an EV to EBITDA basis, obviously, I think with the rise that we'd seen in prices, they were trading at the higher end of their valuation range. But selectively, in my opinion, I think the Indian domestic story should still hold on. So yes, I think stocks like JSW Steel, even Steel Authority of India, where in my opinion, again, I think a whole host of factors which have played negatively against it, higher capex, what probably happens in terms of the return ratios, have largely played out to the stock price. So any significant decline from the current level, in my opinion, becomes a good starting point for long-term investors.
Quick thought, Mayuresh, a follow-up since you're talking about metals. HEG, the buyback announced, the price announced. What do you do with the stock now?
No, so Neeraj, morning. So anybody holding the stock, I think, is reaping the benefits at this point of time. The buyback is definitely higher than what most of the analysts had pegged. So what kind of an acceptance ratio does come through is going to be very, very critical. The second element obviously remains on how the industry is poised and how HEG is poised in that entire scheme of things. So the industry is looking pretty strong and stable at this point of time. Even if one accounts for addition in terms of the electrode facilities in China or otherwise, I think the demand still outstrips the kind of supply that can come through over the next 3 to 4 quarters, to say the least. The second element obviously remains in terms of supply of needle coke. Now, how that supply is going to pan out will largely determine the kind of utilization levels and the utilization of plants, not just for HEG, even for Graphite India. And I think the assumption of 80-90% utilization levels with the assumption of no disruption in supply of needle coke should hold these stocks in good stead, at least from an EBITDA perspective. So I think a large element in terms of how their operating performance has been should largely continue for these stocks. And though I think one really accounts for prices to move up and margins to contract from the elevated levels that we had seen, there is still strong cash flows that these companies can exhibit. So I think it's a very strong move in terms of what the company has thought about in terms of the buyback price, the acceptance ratio, and anybody holding onto the stock. I think the growth is obviously there for the next 3 to 4 quarters. So that's one call that the investors need to take, either from a growth perspective or the pricing perspective.
Capital return in a more emphatic way or more capital friendly way as well to shareholders via this buyback. Stay on, Mayuresh, so much more to talk about. Let's talk about all the key stocks in news. We also briefly talk about the Siemens meeting takeaways. They had a select editors meet yesterday. And then, of course, consumer CG Power had an analyst meet, so talk about that as well. Yash, Agam, as well as Darshan joining to talk about that. Good morning to all of you. Yash, let's start off with you. The key stocks in news today.
Right. I'll first start with the GIC Housing Finance. They came out with their Q2 numbers. Net interest income, that is down by about 5% to 89.8 crore rupees. Net profit is largely flat, coming in at about 46 crore. Sun Pharma will be in focus after the company said that it will be acquiring Japan's Pola Pharma in an all-cash deal worth $1 million. The transaction is expected to close on or before the 31st of January next year. In a separate announcement, the company also said that it has settled its ongoing litigation in terms of one of its drugs, the terms of which are yet to be disclosed. IFCI, there the company said that it has received some 492 crore rupees in terms of the resolution passed by the NCLT in the Binani cement issue. Now Bharat Ventures, the company has received a big order for the supply of 125 megawatts of power to Telangana State Grid at a price of 5.75 rupees per unit. Sunil Agro, that's a small cap company, has a market cap of less than 50 crore rupees. That would be in focus after the company successfully completed the expansion of its production facility and has also started production there. That apart, we would be also watching out for any reaction on the future group stocks on the back of an ET report suggesting that online retail giant Amazon is in talks with the group to buy out the latter over the long term.
Watch out for all of these names. Thanks a lot for the Yash. A lot of small names, but a couple of interesting ones out there. Well, talk about analyst meets and company comments there. Let's start with CG Power, Agam.
Right. Well, there's some mixed cues coming in from analyst meet for CG Power. When it comes to the positives, the management has suggested that there are enough levers beyond capex to accelerate growth, and new products now account for 13% of revenues. And they've also given a clarification on the loan that they've given out about 760 crores worth, and this was to the to Avanta Holdings, their group company. The company has also given updates on its Hungarian divestment, and they say they're awaiting the NOC from authorities there, and losses in the Hungarian business have also reduced to a certain extent. Belgium and Ireland businesses have starting to see a turnaround that could be a positive going forward. They've also suggested that their industrial systems business continues to perform well. However, their power systems business continues to remain subdued. So, mixed cues coming in there on the whole. While we have one brokerage which remains positive, the other one has remained relatively negative on CG Power for now.
Okay, let's wait and watch what happens there. Thanks a lot for that, Agam. And then to Siemens, and what did the management have to tell us, Darshan?
Yeah, so basically they had a meeting in their office, and the MD and CEO spoke to us. He was cautiously optimistic on the future. What he says is that the business is picking up after 3 to 4 difficult years that we've seen. Transmission capex is shifting from power grid to state discoms is something that we are looking at, and that is where he sees orders coming in, because power grid orders are coming down significantly. They're seeing capex increasing in auto, power and the food sector. They're saying that there are lack of large orders, but that is being compensated by robust growth in the base orders. That is something that we're looking at. The captive segment is picking up, and the infra segment remains strong. Digitization, according to them, is the biggest emerging trend. And as far as the mobility business is concerned, there is no clarity on the timing of the divestment, is what the management said.
Oh, interesting. Thanks, Darshan. Thanks for putting that into perspective. Mayuresh, any thoughts on Siemens? The numbers seemed okay. The stock had reacted a bit, but the management commentary, not overly bullish, but fairly constructive.
Oh, it is. And again, I think if you look at a large element on how these capital stocks, including Siemens, has performed, I think the results were very, very encouraging. Now, one might very well argue whether this trend is here to stay and how the execution might very well happen. So I think the kind of order flows that have come through, and with expectations of the government front-loading a lot of these orders even in the quarter to come, I think you are probably looking at the scenario where execution is going to be very, very paramount. The other element obviously is the capex to GDP. So again, I think what kind of private capex does come through over the next few quarters is going to be extremely critical for all these companies. And the third element that obviously stays is with improved execution, with improved working capital dynamics, the operating leverage, both in terms of margins and bottom line, plays out very, very effectively. So if the trend continues for these companies, I think they are in a very, very sweet spot and an inflection point. So yes, I think it was a mixed bag in terms of the outlook, because the outlook itself probably after Q3, when you're entering into the election season, might be a little bit on the softer side, along with the private orders actually softening as well. So again, I think it's something with a long view that investors can probably look at these stocks. But yes, as a sector, I think it has done well in the quarter gone by. I think ABB is something that we still continue to prefer on declines.
Okay. And ABB is what Mayuresh prefers in this space. Let's bring in our technical experts in, Hadrien, Mendonca, as well as Amit, Harchekar, both of them joining us this morning. Gentlemen, good morning to you. I'll start off with you, Hadrien. The Nifty now, just around the 10,600 mark, however, not being able to sustain it in the last few days. What's the call on the index? Is there any trade here? And the surprising outperformance of the Bank Nifty yesterday?
Yeah, hi, good morning. So, there are multiple patterns that we are observing are changing, in the way the markets are reacting to a lot of things around here. So, if you see, yesterday we saw Nifty broke down from a head and shoulder pattern on a smaller time frame chart. But simultaneously the move was so sharp, and almost 100-point move has actually lifted the Nifty towards the levels where it is on the verge of already negating that head and shoulder pattern breakdown that we saw 2 days back. So I think markets are getting very dynamic in a very short term. So it's becoming a little difficult to gauge how things are going to pan out in the next 1 to 2 days. But I would go ahead and stick out my neck and saying that it would be preferable to be long at the current juncture. Especially 10,650, 10,700 zone is an important resistance zone that I would be watching out for. If we see a break above this zone, I would definitely be an aggressive long buyer in the markets. As far as the Bank Nifty is concerned, if you remember, we were of the view that Bank Nifty will be the index that will be leading the rally, and I think the outperformance is absolutely not surprising because we are seeing the likes of heavyweights like ICICI Bank and HDFC Bank, who have already broken out on their respective short-term charts, are living up to the expectations of the breakout. So I think Bank Nifty will definitely continue to lead the rally from here on as well. In the short term, the next target for the Bank Nifty would be 26,800, 26,900 that I am expecting. There is a small hurdle that Bank Nifty has to breach, that is the 26,400 resistance, before we could see the targets being achieved in the near term. So Bank Nifty definitely, anybody who is holding long position should continue to hold on to them.
Okay, got that. Amit, what about your index call?
Well, I have a negative view on the markets. For one reason, we are expecting the dollar index to rise to 99, and that is already putting pressures on most of the commodity stocks. Even sectors like IT, which earlier used to outperform with the rise in dollar index, even that is declining in last few days. Most importantly, if you see the Nifty IT index from a medium-term perspective, it has given a clearly breakdown from a head and shoulder pattern, and we are expecting minimum downside of 15% in IT index. Same is valid for pharma. We have seen a good breakdown in Nifty Pharma index. Even yesterday's closing was quite interesting for that. So overall, we think this market would be brought down by IT and pharma in the near term. Banks will outperform the market, but it should be a buy on declines. So we are expecting that unless we have an event where Nifty manages to close about 10,800, there is a very high likelihood that it should move lower toward 10,300. Another reasoning to provide that the market is weak is yesterday we had a breakout in India VIX. It has closed about a crucial point of 19.6, and now we are expecting that India VIX to rise towards 24. So that is clearly indicating there could be a risk of trade in this market. So unless we have a move which negates this downtrend overall with a close about 10,800, we are expecting it to head towards 10,350.
Okay. Stay on, gentlemen. Let's get our special segment, Bloomberg Edge. It's 8:50, that time of the show. When we do that, Yash Upadhyay tells us about a pattern that the Bloomberg terminal has thrown up on a stock. Yash, what's the stock on your radar today?
Morning, Neeraj. So the stock today is actually Praj Industries, and there a buy call isn't come on the back of the stochastic indicator. But first, let's try and understand what it is. Basically, it's it's a momentum following indicator which helps you identify an overextended price move. It measures the current price relative to the highest highs and highest lows. How do you interpret it? Overbought levels are at 80 and oversold is below 20. Any crossover indicates a buy or a sell signal. In this case, the buy signal has been generated where you can see the blue line over here that has crossed from below the white line and has formed a positive crossover. Now this crossover has actually taken place almost 3 to 4 times in the last 6 months, and we've seen steady gains coming in the stock. So do watch out for that one.
Okay, and how does this indicator work for Praj Industries historically, Yash?
So historically, 7 out of 9 times the indicator has given you positive returns, and the positive returns are to the tune of 11% and higher.
Okay, thanks a lot for that, Yash. So that's interesting on Praj Industries. We'll watch out for this stock as well. Remember, selectively, some of the cap good companies have done well. This is not strictly capital goods because it caters to largely one segment. But let's wait and watch if Praj Industries can have some gains in the session today or over the next couple of days as well, or no. Okay, specific stocks from our technical experts. And Hadrien, let's start off with your ideas. You have a sell on a Gale futures and a buy on Apollo Hospitals. Explain the rationale.
Yeah, absolutely. So Gale, has been gaining good strength in the past 1 week, but that strength is unable to live up to that momentum that Gale was actually showing. I think Gale has already broken down from a rising wedge pattern, which is not a good sign over here. So I think one can consider short selling Gale November futures for a target of 330, keeping a strict stop loss at 343 on the upside. The second one is Apollo Hospitals. The stock has shown tremendous potential and tremendous momentum in yesterday's trade. In fact, if you see the overall breakout on the daily charts, we have seen a very beautiful retracement, after which we saw a very strong move yesterday. So I think it is a clear resumption of an uptrend for Apollo Hospitals. One can consider buying Apollo Hospitals at these levels for a target of 1295, keeping a stop loss at 1228.
All right. Amit, what about your stock ideas?
Well, my first pick would be going short on Infosys. As we were discussing, a breakdown in Nifty IT index with a potential downside of 15%. Infosys, we are expecting a fall of at least 8 to 9%. So here what we suggest is keeping a stop of 645 on a future side, and we are expecting short-term target of 580. Second pick would be going short on JSW Steel. Again, yesterday the stock has breached the rising support line, which was at around 325, and now the turnaround in JSW Steel future would happen only if we close above 330. So right now we are expecting a stock to decline towards 300 odd levels. So that should be the area where one should cover your shorts. And last would be buy on Britannia Industries. We have seen a massive turnaround in FMCG index, and we are expecting the rally to extend further by 5%. For Britannia Industries, we have seen a good breakout about 6,000 levels, so we would suggest keeping a stop of 5,900 on a closing basis. We are expecting a rally in Britannia Industries to extend towards 6250.
All of these stocks, Devina, in trade yesterday had a big bang move. So Britannia has a breakout, as Amit was saying. HUL, highest volumes in a month, and the stock was up about 2.5%, 3% odd. Dabur and Colgate Palmolive.
Godrej Consumer, Jyoti Labs.
Everything. Had a big move. And frankly, look at the volumes out there too. This is not just price action. The volume picture. This is, I think we'll just try and put up a Bloomberg chart on the volumes for HUL. The highest volumes for HUL in a month in trade yesterday. And frankly, for others too, at least I know about what happened in terms of volumes to Colgate Palmolive as well. Those volumes, and Dabur, the volumes are almost 2.5 times the 20-day average. Mayuresh, various reasons can be attributed. Palm oil prices have come off marginally, or maybe the market sees merit in giving higher valuations because IT and pharma have come off. What would you attribute this move to? And are you buying anything in the FMCG space, any one stock?
No, Neeraj, again, I think a large element in terms of what the move is, the premise is basically on expectations of volume growth normalizing and steadily improving hereafter. The second element obviously is that input costs have come off. So whether you talk about palm oil or the palm oil futures, I think they're still trending lower. Copra prices have come off significantly. So I think a lot of these players actually start reaping the benefits of lower input costs. And because they had taken a certain element of price hikes because of input cost inflation in the previous few quarters, I think the kind of expectation that one has that they will lower the cost very, very marginally adds to the leverage on their balance sheet. So again, I think valuations is something that one really needs to be very, very careful about. I think most of these stocks are now again trading at lofty valuations. But again, I think is the growth parameter here to stay? Is the growth here to gradually improve, both in terms of volume-led realizations, which will add to the leverage on their balance sheet? So selectively, I think stocks like a Britannia, even though I think they are almost at the higher end of their median range, any decline I think becomes a good buying opportunity. There are stocks like a Dabur, for example, or even something like an Imami, which is largely underperformed. And yes, numbers also attribute to their underperformance. But again, normalization and recovery in terms of their core businesses can actually have huge amount of an earnings upgrade FY20, FY21 onwards. So I think buying a basket, in my opinion, becomes a far better strategy specifically for these FMCG stocks.
Interesting, Neeraj. We were discussing the other day, and there was an Edelweiss report which spoke about how to ride out the next year in two halves. The first half prior to the election, prior to the other factors and the volatility, whether to sit on defensives, buy defensives and sit on the edge and make sure that the defensives, give you that additional kicker to your portfolio, but be ready to invest in high beta names once, all that has passed over and the second half looks a little bit more clear. So, whether or not that plays out is something you need to wait and watch, but definitely FMCG as a pocket seems to be garnering some amount of interest now. 1.5 minutes left to go for pre-open. Just one call, I'll come to you, Amit, on a Tata Steel. And how would you trade this particular stock?
Well, I think if you see the correlation wise, it is reacting to the rising dollar index. There is a possibility that it could bottom out around 515. So I would wait for a dip towards 510, 515 to add it from a long-term perspective.
Okay, well, Amit is playing by the book. He's going short on metals, going short on IT, and going long on consumer. Hadrien, just one quick call on any of the IT names which showed a bit of a pullback in trade yesterday. Would you go out and be a braveheart and buy any of those names?
Yeah, in fact, with a disclaimer, I would like to, advise the TCS because, we have seen TCS almost forming a double bottom formation on the daily charts. We've also seen TCS holding very strongly to its long-term 200-day moving average. We have not seen it break on a closing basis as of yet. So I think that both these parameters should be a good opportunity where one can actually consider going long at these levels. In terms of risk reward, it seems to be pretty favorable here. So I think keeping a very strict stop loss of 1810, I think we could expect TCS moving towards the 1900 levels in the near term. So definitely TCS would be a stock that I would go ahead and be a brave heart, advise a brave heart buy on a TCS at these levels.
Okay, so slightly more contradictory in terms of opinions coming in there. Pre-open just a few seconds away. In fact, they're on your screen. So about 0.5% higher on the Nifty, with the Sensex also moving up, and that's cooled off already. So in a matter of a few seconds, we'll wait and watch for these prices to start to cool off. Losers, BPCL down 9.6%, Hero Motorcorp down 1.3%, NTPC down 1%, Wipro down 1%, Kotak Mahindra Bank down 1%, Axis Bank, that too trades lower, L&T is down 1% in the session, Vedanta is down 0.5%, and so is Hindalco. Z trades under by 1/3%, right now. BPCL now down about 2%, Tech Mahindra loses some more. Amongst gainers, Yes Bank powers up in today's session after that blip of 3.5% in yesterday's trade. 201 on Yes Bank now. ICICI Bank, that's up about 5%. Sun Pharma, that's up about 3.7%. Eicher Motors up 2%. HCL Tech, Dr. Reddy's, Coal India, Bharti Airtel are some of the bigger gainers in trade. Even ITC, for that matter, has moved up. Should see an HUL, and whether there's a follow through in an HUL after yesterday's big move that's coming on the back of heavy volumes. HUL unchanged for now. Currency, well, that moves back to 71.
Yeah, well, yesterday itself was a bit of a drawdown for the currency. After starting off well, we corrected and ended marginally lower in today's session, back to 71 odd levels. Okay, let's bring up HEG and see what that one is doing in the session today. Is it reacting at all? The news came out during market hours yesterday. The brokerage notes came out today, so I thought maybe there could be a bit of a reaction. No, not quite. Let's see if there's a reaction in Navbharat Ventures. That's a stock in news into some power supply agreement, but no, not quite. No big moves out there. What is certainly moving is 8K miles. I'm surprised at the move, but nevertheless it continues to move. Unichem Labs, certainly a stock in news. EIR received, so the inspection that was initiated in June has come to a close, and I would reckon the market would want to believe zero observations or no negative observations, and which is why this brief uptick, I don't know if it'll last or no, but certainly looks like Unichem Labs could start off on a good footing in the session today. Aside of that, don't see too many big movers on news. City Union Bank is up about 5%, but don't quite know if there's a set of news moving this, and don't quite know if this will last or no. What's corrected, and by the way, come off quite rapidly, is Jamna Auto. It's at 69 now. So a much fancied auto ancillary name, fairly heavy on the valuation front at 85.90, has now corrected quite a bit, in line with some of the other larger peers as well. So this stock is sub 72. Arvind down about 1% ahead of the demerger date tomorrow. CSC marginally off, but nothing too dramatic really in terms of movement. But for Unichem Labs, 6% higher in trade. Wondering, Mayuresh, do you track Unichem Labs, and did you see the news bit? They've received the EIR.
I just saw the news bit, but not tracking it, Neeraj.
Okay, interesting. But the stock shows a bit of an uptick in the session today. I must say though, today what's really been a good read in the morning have been the brokerage notes. The 2 or 3 of those notes that came out have been quite on the button to my mind. But Samit Sarkar Johnson with what he believes are the top brokerage calls for the morning. Morning, Samit.
Well, including the metal note that you just spoke about, the other two brokerage notes that were the key highlights for today morning. The first one was the Bank of America Merrill Lynch on Reliance Industries. The brokerage has maintained its buy rating on the stock and has hiked the target price on Reliance Industries to 1,430 from 1,218. According to the brokerage, heavy investments in the last 5 years by Reliance Industries in consumer space has helped the company transform from an oil and gas major to a company with presence now in telecom, digital and the retail space. With better than expected traction seen at Reliance Jio, Reliance appears to have crossed the tipping point in terms of consumer acceptability on the B2C front, that is the business to consumer front, says the brokerage. Now this shift from B2B to B2C will not only help the company sustain its valuation but could also drive a re-rating for Reliance Industries going forward. Lastly, the brokerage has hiked the target price on Reliance Industries as they have now factored in upside from its various other sectors, that is media, retail and the telecom business. Second we have is UBS on IT sector. Now Indian IT service sector has reacted negatively to the recent strength seen in the Indian rupee against the US dollars. Now in these situations, according to the brokerage, companies with better organic revenue will be better positioned according to the brokerage. Now this rupee depreciation has also put the consensus margin at risk and the brokerage has now been more cautious on this sector. Now along with this, fears of a global macroeconomic slowdown has also weighed on IT stocks, and the recent fall in the IT stocks have now begun to factor in the revenue slowdown, says the brokerage. Lastly, the brokerage says that they continue to remain selective when it comes to the Indian IT space, and in this recent fall they expect that it is an opportunity to add stocks like TCS and Infosys.
Okay, got that. So Amit, thanks very much for that. We've discussed IT quite a bit already. But Reliance Industries, Mayuresh, right now for you?
It's a very interesting play. I think if one really has a view of more than 2 years, 3 years, I think what the company has transformed into a telecom and a retail unit, and the expectations largely are laid out over the next 5 to 10 years of them contributing significantly. I think that's going to be a huge value addition for the overall stock. In terms of their core businesses, again, I think time and again we've spoken about this. But again, I think with the off-gas crackers, with the expectations of better feedstocks coming through, both in terms of imported ethane replacing ethylene, I think that's going to be a huge value addition as well. And again, I think with the changes that are happening with the maritime organization and Reliance predominantly being a player within the middle distillates, I think the crack spreads along with the capex that will probably go through, I think the refining margins will improve for Reliance even in its core refining business. And I said, the petchem business, because of better feedstock, their realizations will improve because of the leverage created and the EBIT margin improvement seen thereof. Jio has held out pretty well both in terms of reported ARPUs and the expectations in terms of the RMS share improving for the company going forward, with bottoming out of tariff plans probably expected in the next couple of quarters, should see better performance. As far as capex is concerned, I think a large element of the capex is already done. So I think the benefits that they will reap from all these different sub-segments will actually play out very, very meaningfully FY20, FY21 onwards. So yes, I think the long-term outlook remains very, very positive on Reliance. I remain positive, and a clear disclaimer, we own this stock in our funds.
I just like what the note is saying, Devina. And the thought process, whether or not the market gives that valuation multiple or not remains to be seen. But the fact that Reliance is now increasingly a B2C company as well, and whether the market in due course of time over the next 3 years assigns it multiples of a B2C player as opposed to a pure B2B player, because B2B players will obviously receive a lower multiple. And if that were to happen with an increase in earning trajectory, then does Reliance have a potential to gain not just because of the earnings growth, but because also of a valuation re-rating, and what kind of upside that leave to? So the Bank of America Merrill Lynch note, while their immediate target is 1428 or 1430 or thereabouts, they believe that the blue sky scenario upside potential could well be 75% from the current price levels.
Oh, wow, that's really something to see whether that culminates into that kind of activity or no. But they're moving in the right direction for that. The other one, probably, we've been talking about steel producers, a smaller name out there, and we've been getting some queries on the same. Hadrien, I'll come to you. A stock like Prakash Industries in January traded somewhere closer to 250 rupees, currently at 93 rupees. I mean, whether the downside here sees, whether it's seen a bottom now at 93, or whether there's further downside left, according to you.
No, I think the stock is really looking weak. In fact, if you see the overall structure is a lower top, lower bottom, cycle, which is not a good thing for any long holders in any stock or any index. So I think Prakash Industries is really looking weak. In fact, we have seen a fresh consolidation breakdown in yesterday's trade because of the sharp move that we saw on the downside. So I think any kind of rally, whatever comes in Prakash Industries, I think it should be a good opportunity to trim your positions, and it is advisable to kindly avoid these kind of stocks that are not in momentum. There are many better plays like and blue chips are showing good momentum. So I think we should stick to those rather than something like a Prakash Industries. Sorry.
Okay, got that. 5.5 minutes left to go. I want to quickly slip in a question on pharma as well. And anything in particular, Mayuresh, within the pharma pack that seems of interest to you? Obviously, right now they've lost their sheen. Most of them have seen cuts in the last few weeks of trade. But the likes of a Dr. Reddy or a Sun Pharma, the bigger names or the smaller names for you?
So I think the bigger names are a clear hold. But what we really like, even from the current level and on declines, from the mid-cap universe are stocks like an Aurobindo Pharma, where our belief is that the earnings trajectory should still hold out. The two acquisitions are obviously aiding them in a significant manner. And what probably happens in terms of new launches and the injectable business, I think the margins thereof are relatively better off than the core businesses. So I think earnings growth should be relatively better. What you've probably seen in terms of R&D expenses, I think that should probably normalize. And the capex again is as per their standard outlay. So again, Aurobindo is something that I like. And one more stock, I think Granules India has corrected again from the recent highs. Any significant decline probably starts becoming a very good opportunity because of the huge scope that it has got. Expectations of the oncology division expected in Q4 of this fiscal, and what happens with the new facility specifically in terms of its fixed dose formulation will largely entail how the 13 ANDAs which are pending will come through. And again, the expectations of how the new facilities and utilization levels thereof. Ibuprofen has done exceedingly well when you're talking about paracetamol, 80% utilization on the API business, and the plant thereof holds that in good stead. You've seen input cost increases actually happen because of disruptions in China, but they've started taking price hikes. So what happens with the metamorphine launch, I think it has been very, very critical. And again, I think the expectations of new launches in the US market will hold up its earnings trajectory. So I think any significant decline on a stock like Granules also becomes a very good buying opportunity.
Minutes away from Market Open, let's tell you all that you need to know to stay ahead in trade today. Reports say that South Korean conglomerate Lotte is looking to buy stake in ONGC Petrol Additions or OPAL.
The Economic Times report that the promoters of NIT Tech are looking to exit the company. They are planning to sell their stake at a substantial premium.
Morgan Stanley in its report on metal stocks has upgraded Coal India to overweight. On the other hand, it has downgraded JSW Steel as well as JSPL.
Analysts continue to bet on Reliance Industries. The latest to join this list is Bank of America Merrill Lynch. The firm has raised its price target on Reliance Industries to 1430 rupees. It says the shift to the B2B space will aid the company's valuations.
Now, Bharat Ventures and its AR arm have signed a contract with Tata Power for trading for power supply to 125 megawatts to Telangana State Grid.
And lastly, IFCI received 491.84 crore rupees through the National Company Law Tribunal on account of the Binani Cement resolution.
Okay, that's the long and short of it. Mayuresh, a quick 30-second answer before we let you go. Yes Bank, I presume on account of the story that was on Bloomberg and Bloomberg Quint, I think they've repaid some of the monies to Reliance Mutual Fund and Franklin Templeton. The stock has rebounded a bit in trade today. Would you go out and buy it?
So it was holding out. I think this news obviously should lend huge support in terms of the sentiments towards the stock. And I think the leadership change who comes in over the next few weeks is largely going to determine the success of the capital raising program, which they seriously need because of the growth that they've probably delivered so far. And if they expect to continue, I think the capital raising should come through. So yes, I think there is some element of confidence because of the repayment that they've done. So expecting a positive tick. But again, I think if it declines around that 170, 175 mark, there is value in the stock.
All right. Thank you so much, Mayuresh. Appreciate you taking out the time and being with us this morning. That's Mayuresh Joshi out there. 1.5 minutes left to go for market opening. Let's quickly run through some ideas and some top calls from our technical experts. I'll start off with you, Hadrien. What's going to be your top call for the morning?
Yeah, I'll go with the long Maruti. Looking at the consolidation breakout that we are seeing, along with the 50-day moving average also been broken pretty convincingly in yesterday's move. I think Maruti should be a stock that should be on a buyer's radar. Especially if we open up on a lower side on a Maruti, anywhere close to 7,500 should be a good opportunity to accumulate the stock. So I think it can go long on a Maruti for a target of 76.50 in the near term.
All right, what about you, Amit?
Well, I would go short on DCB Bank. It's clear triangle breakdown. Unless we have a rebound above 161, we are expecting target at 147.
Okay, we'll watch out for these names. Hadrien as well as Amit, just stay on, gentlemen. We'll just take in opening thoughts for you from post-market open and then let you go. But it looks like we'll start off on a very flat note if the pre-open rates are to be believed. So, about 10,620 or thereabouts for the Nifty. The Nifty Bank, which was the principal gainer yesterday, could be an interesting one to monitor as well today. Does it show a bit of profit booking in the session or does it hold out? So all those questions answered in just 2 seconds now. Here's how the markets are starting off this Tuesday morning. Flat as flat can be, even for the Nifty Bank. No dramatic reactions. Now about 0.25%, but very, very flat. I doubt that the mid caps and the small caps would be doing something dramatically different. It's a flat start. Remember, these indices had underperformed yesterday. At least the small cap index was in the red when we closed. Mid caps open closed marginally higher, but in today's session very, very flat. Let's bring up the heat map. I don't know how many stocks will be reacting too much. Yesterday was a different day because a lot of stocks reacted. In today's session, firstly, the red overpowering the green. But what's doing well? IT has bounced back. So the bounce that we saw in the second half of trade yesterday continues. By the way, in the US too, FANG stocks moved up, but the Indian stocks, Infosys about a couple of percentage points higher, HCL Tech about 1% higher. There is strength in TCS too, marginally higher. So 2 or 3 names in the IT space doing okay. Dr. Reddy's is doing well, and Yes Bank has bounced back in the session today, about a couple of percentage points higher. They've repaid some of the loans, as we said, to the 2 mutual funds which are holding the credit papers of Morgan Credit and the other vehicle. What's not doing well? JSW Steel. So the metal pressures continue. JSW another couple of percentage points lower. Vedanta down another 1.5%. But aside of that, don't see too many moves really into any of the large cap names. So I reckon that the action would be centered around what's happening in the mid cap space. Frankly, on the large caps, it's only IT which is standing out as one principal gainer. Devina, what are you spotting?
Well, the mid caps and the small caps that relatively, underperformed in yesterday's session. There's some amount of a pickup, but not much. So you've got the likes of an IFCI, a small name there, up about 6% odd. Zydus Wellness at 1178 now, 2.8% higher. Marksons Pharma does well. Unitech, NIIT, that's NIIT Limited, it's up 2%. Hexaware is up 1.85%. VIP Industries does okay for itself. Inox Wind is up about 1.5%, and OMDC, that's up 1.5% as well. You've got the likes of an RBL Bank, Sterlite Tech, Suven Life, that's up about 1% in the session right now. KPIT Tech is doing okay, and Andhra Bank also moves up right now. Amongst the bigger losers, just going to quickly highlight some of those. The gainers, I think my pricing
space. I think if I look at the losers, Devina.
Jet Airways.
Yeah, I think Jyoti Labs, SAIL, JSPL are amongst the names that kind of stand out. Jet Airways is one more, and Arvind, the head of the demerger, is down about 1.5%.
Radico Khaitan, Chambal Fertilizers, TDK Prestige, MRPL are some of the other names there that are looking weak at market opening.
Okay, quick thoughts from our experts before we thank them. Amit, I'll start off with you. IT is behaving slightly differently. Infosys, in fact, has started off a couple of percentage points higher. Would you use this opportunity to go short, or are you holding on to your call for the time being?
Well, my sense is unless we have a close above 645, the trend seems to be on the negative side. We don't expect this rally to sustain because globally even Nasdaq has seen a good breakdown. So quite cautious on IT even on this pullback.
Would say that you would go out and use this opportunity on Infosys to go short. It's at about 636 currently.
Well, my sense is if we have a close above 645, I will cover the short. and again reinitiate short the moment it closes below 620. So overall view is, since it's a breakdown from a head and shoulder pattern, we are expecting bottom to take place only after a correction of 15% lower. So it would be, this is a corrective up move, it won't sustain for long.
Fair call. Hadrien, quick thoughts, anything that stands out either on the index or specific stocks for you?
Yeah, so again, Marico is a stock that is really looking strong. I think it still has a lot of space to move higher from here on. So from here as well, for a delivery basis, Marico should be a stock that should be on a buyer's radar. In the short term, we're expecting a target of 370 in the near term.
All right, got that. Gentlemen, thanks very much for joining in. Appreciate your time. Hadrien as well as Amit, thank you. Well, let's get in one more important market voice then at this point. Vikas Khemani, founder at Carnelian Capital Advisors, is joining us on the show right now. Vikas, good morning to you.
Good morning.
Well, it's slightly more volatile this time around from the last month, where we've seen 4 straight weeks of gains coming in for the index, taking it back to levels of closer to 2,700. Start to this week was a little bit slow, but individual sectors are now getting more attention. We've seen IT and pharma starting to peter off a bit, defensives like FMCG starting to gain flavor, and commodity plays are having a different color to themselves as well.
So I think, if I were to look at markets right now, we had a shock to the market recently, and which kind of led to a big sell-off, and a lot of leverage position got corrected in the market. Market has come down to sort of a reasonable level, and now I think individual sectors, based on the dynamics of each of their in the current context and as they look forward, are now being played out. So I would say the froth has got cleared. Earlier everything kind of was going up, market was in a momentum bullish mode, and I think as we see now, given the results, look at consumer companies, as the oil has started coming down, all the consumer stocks have started doing well, because that has an impact on their margins, and volume seems to be doing pretty all right. So I think in that kind of environment, consumer is supposed to do well, and it will do well. IT and pharma, which were defensive, which did very well when markets fell down, is bound to give away some of the gains. But I do believe that both these sectors would have a reasonably good long legs. I don't think they are kind of short term there might be some corrections, but still a lot more to go. And IT, I think developed markets, we have reasonably good growth ahead of us. Volumes are picking up. If you hear the commentary of the companies, they are guiding very well on the deal wins and potential pipeline. That clearly shows that there is a and in a way I believe that whatever is going on digitalization, in some sense it is a Y2K equivalent or second Y2K equivalent moment, because there's a lot more needs to be done in terms of data reorganization, in terms of it's not only about high tech stuff. You need to get geared up, and I think that will open up business for IT companies in India, and that's visible as well. So I remain quite positive on both these sectors. The way I see markets now as we move forward, I think we had lots of macro uncertainties which are kind of panning out. Now things have settled down, and from here on, as some of the uncertainties like elections, from here to over next 5-6 months, you will see that market consolidating and then taking a meaningful direction from here. Good part is that Indian economic activity is reasonably solid. Economic growth is all right. I don't think we have any sort of systemic kind of crisis at play, and that gives me confidence that after this shakeout, I think we are forming a nice ground for a good takeoff in next 5-6 months' time.
So the last one particularly has been relatively important, because we've seen crude oil coming off sharply, the currency strengthening back to about 70-71 levels, macros looking slightly more better because of crude oil prices coming off. But on the flip side, earnings were slightly more subdued. I mean, people would have anticipated a lot more from corporate India than was actually delivered. How did you make sense from the earnings that came out, and whether or not you would rejig portfolios based on that?
So I was not as disappointed by the earnings, to be very frank. I think volumes were reasonably well in place. I think some amount of disappointments were there because of the shock which we had in the system, which kind of either shot up the interest cost or created some ancillary cost, and also because of the rupee movement, there was an adverse movement on some of the companies' margins. But that was temporary in nature, and as that is going away, you are seeing things coming back. So I am not very worried about, as long as demand environment is strong, as long as the economic activity is strong. I think this earning, sort of disappointment, whichever sectors we had, would come back. Because I think underlying trend is positive. We might have these kind of setbacks, and we have had many of them in last couple of years. So it's not that we've had one way good couple of years of good earnings growth. We have not had. But I think I am hoping that at least, given the kind of environment, I am personally all right. I'm happy with the kind of earnings which have come out. And in this time, you got to again look back and rejig your portfolio, keeping in mind which are the sustainable plays, where you've seen a lot more value correction happening, good quality companies. You are seeing lots of good quality companies available at a reasonably good price in many sectors. And I think so. Hence, one can kind of really look at rejig the portfolio. Underlying trends don't change. I don't think the financial stories have changed. I don't think India's consumption story has changed. In fact, some more dimensions have got added. I believe that India is a very big beneficiary of, in some sense, ongoing US-China trade war. We are seeing lots of manufacturing plays are becoming a lot more viable, profitable, and people are putting capex in that. I mean, that's one more dimension which, if I were to talk to you about a year and a half ago, was not there. So I believe that in India we are adding more and more stability dimensions to the story. So underlying trends, I don't think are changing. I remain as convinced as I was a year ago or before.
Interesting. Because from the sell side to being a money manager, I believe the quantum of the number of companies that you necessarily need to look at changes dramatically. So within your universe, if I can use the term coverage universe right now, do you believe there is a possibility of earnings growth looking northwards of 15-20% as well?
Well, it's quite possible. I mean, by the way, if you take a select carved universe, companies have been growing at 15-20%.
That will always be the argument.
That will always be that, and that's your job as an investor, even for that matter, sell-side advisor, that to look for companies which are delivering superior, or outperforming earnings. Market outperformance is not in your hand, but outperforming earnings or delivering sustainable economic value. And I do believe that you will always find that.
So where are you finding these pockets? And are you necessarily finding them in the larger companies vis-a-vis the smaller companies? Is the categorization based on that, or is the categorization based on select pockets which are doing well? Because I did hear you say that you believe consumers will do well, you believe IT will do well. Are you finding bottom-up stories after identifying 2 or 3 key sectors? What are you doing?
My approach has always been that look at a bigger theme which is at underplay, and within that theme then go and identify business model which will capture large part of the theme, large part of the growth, and then more importantly, after having done that, identify the manager or CEO or the management team which can deliver that to you. If you might have got first right, second right, but if you get the third wrong, you are done. I mean, we've seen this time and again. So I think you have to find all three, combination of all three, and it's not easy. But once you find all three combination, I think the magic happens. And we have seen, value creation happening, whether it is HDFC Bank or IndianOpen Bank or many more, or for that matter, Britannia in consumer. I mean, you can go and look around. There are lots of and India is one market I feel offers such a good wide depth of width of companies and width of sectors to choose from, very high quality managers. Trust me, you always very often find that you have problem of choice rather than shortage. So I don't believe that. I mean, there are lots of companies. I think over the next 5-7 years, you got to take a long-term view. You got to take a view which there might be disappointments. Like if something like last quarter happens, no matter how great CEO one is, you cannot avoid those kind of risks, no matter how. But can you overcome any of these big overlook and then get back to building your organization? And that's the kind of management team we look for.
So let's talk about that then. One question before I hand it over back to Devina. Let's try and see if you're taking advantage. Metals have corrected quite strongly over the last 6 odd months. Ferrous, non-ferrous, everything is down. IT is the other pocket which is down. Where would you look to place your bets if you're looking purely at large sectors which are performing until the better part of 2017 and 2018, and last 6 months have corrected 15-20%? Both of these indices have done that.
So metals, honestly, I don't understand the dynamics, so very inappropriate to comment. It's a complex sector and I don't understand. IT, as I said, that I do believe that will do well, especially mid-cap IT, where companies are winning disproportionately large deals, which as compared to their past history, that will put them into next league. And a lot of large IT companies may not be able to deal with, given the environment, deal with that kind of demand. So I think we have a good case for mid-cap IT companies. I am also bullish on large-cap IT companies, but at the same time, I feel mid-cap IT companies can deliver 15-20% return over the next 3-4 years.
The other pocket, obviously, that's gaining more traction, more attention now is the cap goods space. I mean, slash with the infrastructure flavor, like a company like L&T, you have Crompton Greaves, from a pure play cap goods space, Thermax. These are all the names that are propping up in terms of interested plays. Would you say that a company like an L&T has been, which has been showing you constant growth, the guidance has been, if they've not really gone leaps and bounds with the guidance, they've been constant with it. So these are the kind of stocks that you need to have in your portfolio to make sure that your returns are actually safeguarded if at all you're not looking at an extreme multifold in terms of returns.
Absolutely. I mean, if you ask me, I think I'm very bullish on industrials, and capital expenditure as a theme, as a sector, because in my opinion, it will surprise all of us in next couple of years. Both private as well as public capex cycle has begun, is kicking off, and we are seeing all over signs in the order book and the results. And L&T also has displayed that in a beautiful way. L&T also fortunately corrected some of the past balance sheet issues over the last couple of years. So I think if you ask me, my personal view is that L&T is very well placed, in terms of capturing, their own sectoral. And yeah, it's a great company, well-managed company, and it is to that extent the risk profile is lesser as compared to any smaller company or mid-cap company. So if you are looking for a reasonably stable India play which can give you 15-20% return, I think those are the kinds of names you should definitely look at. But industrials, will do very well over the next 4 or 5 years. It will surprise, in my opinion. It will surpass our expectation, what we have at this point in time.
All right. And we're probably seeing that show up in the IIP numbers also, with the kind of pickup that the momentum has. Aside from that, you've been optimistic on the private sector banks, and one particular bank that you really like is ICICI Bank. You want to dwell on that a little bit more and why you like it?
So I think, private sector bank as a theme has been a very good, is under play for last 10-15 years. We had in between a period when some of the private sector banks, especially with the likes of ICICI Bank and Axis Bank, who had large exposure to corporate side, ended up taking a big toll on their performance as well as profitability and all. And some of the organizational issues were there around in both organizations. In my opinion, we have overcome that hump. By and large, balance sheet issues are behind. Both are very incredible franchise. I mean, they have a great CASA franchise, great brand, product portfolio, technology. So everything is, I think, in place. All been, there was some organizational issue which have been addressed. So I do believe that at that valuation, given the kind of growth runway you have ahead of you, and faith in the new leadership at both organizations, I feel we have a good value creation ahead of us. So far, private sector theme has been at play, but these organizations did not participate, and I do believe they are all set for capturing their lost glory. And based on my assessment, I may be wrong, but I think they are all set for over the next couple of years for a spectacular run.
Well, it probably showed in a way. The entire clutch of stocks moved up yesterday, save for Yes Bank, which is up in today's session as well. But Vikas, Khemani, always special chatting with you. Thank you so much for taking the time out and speaking to us today as well.
Thank you very much for having me here.
I look forward to having you more often on this call.
Sure.
That's Vikas Khemani talking about his thoughts on the markets and, well, specific pockets as well. Time now to slip into a quick break. The markets are very flat, no moves there. But on the other side of the break, we decode HEG's buyback and expansion plan with Chairman Ravi Jhunjhunwala, and then analyze the factors at play at the metal space with Rakesh Arora of India Advisors. So that's coming up. Stay tuned to Bloomberg Quint Live.
This is a show which gets you a complete wrap of all the stocks that are buzzing in trade.
Everyone's a price taker, not a price maker out here.
There are better opportunities in the marketplace.
The return ratios will improve, margins will improve. What are you seeing? Valuations are extremely expensive.
It would take 100 years of profits to really pay off the entire debt.
Not all good businesses are good investments.
Good return on equity could be expected.
And I think that is sustained.
Their numbers, etc., were pretty sluggish.
How much longer they can sustain, I'm not too sure.
It has never been the scenario in any of the stocks.
It's an avoid for him at this point of time.
I wouldn't write it off in such a hurry.
We are getting into more complex chemistry.
Join me as I navigate the hottest stocks and help you pick the right stock at the right time.
भाइयों बहनों, केंद्र सरकार राज्य सरकार मिलकर के काम कर रहे हैं।
किसान है हिंदुस्तान का, उसको सही एमएसपी मिलेगी। मुझे बताइए सही दाम मिल रहा है आपको?
मैं पूछना चाहता हूं क्यों चुनाव आगे कराया?
My relationship with Mizoram is a family relationship. It's a relationship of love.
अभी तो सपने और बड़े हैं, मंजिल काफी ऊंची रखी हुई है, वहां तक हम सबको पहुंचना है।
Welcome back. You're with us right here on Indian Open. Let's focus on specific stocks. HEG has just announced a 750 crore share buyback and a 1200 crore expansion plan. The company says the buyback is in keeping with the strategy of rewarding shareholders via a mix of dividend and buybacks. Yatan Mota spoke to the company's chairman and managing director Ravi Jhunjhunwala and started off by asking him on how the board came upon the decision to buy back a little less than 5% of the company's equity capital.
The amount of the buyback is 750 crores, and we are going to buy back about 3.4% of the existing equity, which is about 13.5 lakh shares at 5,500 rupees per share. And it is in lieu of dividend to the extent that at the end of last quarter's results, we had announced a 300% interim dividend, and while announcing, we had said that the company would like to maintain its previous payout ratio record of about 35-36%. And considering the first half results and considering the next 6 months projected profitability, we had taken a view that we should announce a 300% dividend at that time, then come back a little later, which is today, with a large buyback, and then leave something again to be given back at the end of the year in April, May, in the form of dividend, in order to maintain that particular ratio of 34-35% payout that we spoke about. So it is basically in line with that.
Okay. And so would the promoter group be participating in this buyback?
Yeah, they would be, and this is part of our announcement which we have done.
Okay, okay. And sir, if you could tell us that you also have announced, capacity expansion. If you could tell us, in terms of the capacity addition, the announcement that you have made to stock exchange, that will be close to 12,000 tons or so. How do you, look at it from the perspective of the future outlook? Because your 20,000 ton per annum project, would be completed in phases.
No, it won't be completed in phases. It will all be done in about 3 years' time. It will all come together. It's not. Okay. There's no phasing into this.
Okay.
And this will take our capacity from about 80,000 tons to 100,000 tons. In terms of, to put it into perspective, this 20,000 ton increase is less than 3% of the total world market currently. The total world market currently is in the region of about 700,000 tons.
Okay.
So this 3% is also going to come in 3 years' time.
Okay.
And given the structural change that this industry has seen because of what China did about 12 months ago, we don't see this changing anytime soon. So we do believe that it's a very small tonnage which is coming out in the market in about 3 years' time. And the market continues to be robust, and we don't see any problem in being able to place these additional electrodes 3 years down the road.
Okay. And so, what would be the cost of this total 20,000 tons, capacity, and how would you be funding the capital expenditure program?
The cost is about 1,200 crores as of now, and it will take 3 years, as I said.
Yeah.
Currently, we have about 1,400 crores on the books as a treasury.
Okay.
So we should be able to meet the entire capex out of internal fundings.
Okay. And sir, as you were mentioning earlier in the conversation that there were certain structural changes in the Chinese market because of which the graphite market is what it is today. In terms of pricing outlook, since the prices have been firm to stable in the last few quarters or so, does the outlook remain that promising? Do you expect the prices to remain stable at the current levels, or do you think the overall market is slightly soft, given the fact that there has been steep correction in steel prices as well?
No, the steel production has not come down, and the market continues to be pretty strong. And we believe that the current pricing should continue for some more time.
Okay. So, the broader question really is that from this 20,000 tons that capacity that you are putting up, will this entirely be dedicated to the export markets?
Not necessarily. Our previous track record is that about 1/3 of our sales has been going to the domestic market, and about 2/3 has been export. So there will be some small changes here and there, but given certain things which have happened in this country, where a lot of these steel plants have changed hands recently, some are likely to change hands in the near future. So this is likely to increase the demand for electrodes pretty steeply in our country also, because obviously these companies who are changing hands or who have changed hands have now gone to much stronger hands. So capacity utilization or further expansions in those capacities will happen pretty soon. So that will lead to additional demand of electrodes within the country as well.
And sir, one final question on the input prices. On the input front, how have you seen the marketplace doing? Because there was recent volatility in the currency, there was recent volatility in crude prices, and how do you see needle coke prices moving up? So, on the input prices, if you could give us a flavor as to how are the things shaping up in the marketplace?
So the input price, basically, our major raw material is needle coke, which is imported. And we have a 6-month contract. The period of contracting has been about 6 months.
Okay.
So as we speak, we are right now in discussions for the prices for the first half of 2019. So we will see what happens. I mean, we still don't know how much increase there is, but there is definitely going to be an increase.
All right, that's the management at HEG talking about their buyback. The other sector in focus is obviously select Indian metal stocks that are trading at their respective 52-week lows as steel prices collapsed over the last few trading days. Curbs on Chinese production is slowly wearing out amidst concerns around the global economy. So is the honeymoon period over for metal companies in India? Companies which made hay while import duty curbs in India and higher demand aided sales in the domestic market and abroad? Let's ask someone who's been tracking the space for years now. Rakesh Arora, managing partner of Go India Advisors, now joins us with his take in the current scenario. Rakesh, thanks very much for taking out the time. I'm going to start off with what's been happening in China, specific to rebar prices, which have come off the peak that we saw in the month of August, almost 21% given off. And not just rebar prices, construction steel as well has been witnessing a lot of pressure, which indirectly is putting pressure for most of the companies here off. What's the sense and what's this likely to culminate into?
Well, see, China is 50% of global demand. So whatever happens in China is highly relevant for the commodity prices. Chinese economy has been slowing down. The last print was 6.5%. And when I read about Chinese economic forecast for next year, a lot of people are talking about number which is closer to 6%. So definitely, there is a slowdown in Chinese demand. And add to that, whatever is happening globally on the trade war, adds to that growing pessimism about demand into 2019. And that is getting reflected into commodity prices now. I wouldn't say that we are already done with the fall. It could be, even worse as things unfold. I think all eyes are on G20 meeting on 1st December. If something positive comes out from there, maybe there might be a little bit of bounce. But otherwise, I think we are in for a more prolonged decline from here on.
Rakesh, the anticipation was that the winter curbs would come in and therefore there would be a lack of product in the market, because of which most steel producers started to flood the market with inventories earlier on. But because China has been a little bit more lax in terms of implementing these curbs, there is a possibility that the glut remains in the market, which again may not be that good for pricing in the near term. How far worse could this get, and the implications for Indian companies thereof?
So in terms of, you rightly pointed out that this time around the production cuts are less severe. And, obviously people were expecting that cuts would happen. But given the state of Chinese economy, I don't think they can really push. And they've changed the barometer by which they measure, the pollution index. So that has given a lot of leeway. But having said that, I think it's more to do with demand. Demand slowdown fears are much more genuine. And meaning supply has been there over the last few years, but it was demand which was really keeping the commodity prices up. And now that is under question. How far worse can it go? Meaning historically we have bottomed out wherever, when 50% of the producers globally are loss making. So what it means to say that when you are 50% into the cost curve, then only things start to bottom out. We are far away from that. Meaning only recently, steel companies were at their decade high profitability. Same was true for zinc, even aluminum to some extent. So we are far away from that bottom if things were to pan out the way it is looking right now.
Do you see the risk for most of the Indian companies getting a little bit more amplified now with the falling in drop in the Chinese steel export prices, as well as the landed cost of HRC products being at a substantial discount to the Indian HRC products, which could mean that the imports could rise thereof, and the implications of that?
Yeah, so meaning Indian market is not really removed away from the global market. So what is happening is going to translate into Indian prices also. Also, don't forget that recently most of these companies have bid for some of those distressed assets, and they will also be very keen to push volume through. So there is going to be a little bit of a supply glut even domestically. So that is also going to add on to the pressure in the domestic market. So overall, things are looking that we are in for a sustained decline in commodity prices from here on.
But do you see, obviously, while we're talking about the lack of economic pickup in China, that probably could not be matched to the economic cycle here in India. Do you see a change in infrastructure spending picking up here, and because of which that could be a slight silver lining for steel companies here in India?
No, India is no match for China. China is 50% of global demand. China is 5%, and India is 5%. So I mean, there's no comparison altogether. Whatever happens in India is not going to influence globally, I would say, at all. Now, coming to India per se, I mean, there will be a little bit of pickup in demand till March. But remember that we are also heading into election season and things start to slow down. So probably another 3-4 months, and then things start to slow down for 6-7 months. And we get a supply glut from all these revamped, restructured assets which have been bought over. So I won't be really too bullish, despite Indian infrastructure doing better than historically.
Right. So Rakesh, in an environment like this, where obviously long-term value creation is something that the companies will be taking on in the process, for minority shareholders at this point, what should be the focus? I mean, should be the focus remain on companies trying to shed off their debt, most of them trading at the net debt of about 2 to 4 times? Is that something that you should focus on when you're looking at making investment into some of these metal companies right now?
See, metal companies normally don't make for a long-term investment. You have to play the cycle. So currently the cycle is turning downwards, and these companies have taken debt at the wrong period of the cycle. Meaning when things are starting to turn down, most of these companies have saddled themselves with debt. So they don't really make a pretty picture in terms of investment. One needs to really wait for the cycle to play out before getting into most of these names. But having said that, some of the companies have been more, better placed, like Coal India, Hindustan Zinc, where they don't have much debt, they are sitting on cash. So they could be at the best hiding places, but when things fall, everything will fall.
What are we to look for going forward, probably into the next 1 year? I mean, while you say you play the metals cycle as a whole, do you see this period of lull changing anytime soon, and thereabouts, which are the more better placed companies to take advantage of the next upturn cycle?
Well, so see, what can change the thesis is, as I said, one is G20 meeting where China is meeting US president, and if they don't really go ahead with the increase in tariff and the trade war comes to a standstill, that is going to give some support to commodity prices. Number 2 is that inflation has come down. If we can get some signals from US Fed that the rate hikes which are being penciled in are going to be lower than that. So these are the 2 variables which can really change the thesis from what I'm saying right now. But the probability of both looks low, so at the moment we need to wait and watch.
All right. Just one last question before we let you go. In terms of we've already spoken about how these companies have been trading at their relative highs. Valuations have been a bit stretched as well for some of these metal names. But in terms of just taking a pure play call on valuations, how would your pecking order look like?
Well, see, I don't really track them so closely, but as I already told you, that companies who are debt-free would be higher up the order, and worse the balance sheet situation would be the lower end. So avoid companies with very high debt, and in this environment, you can't take that kind of risk.
All right, got that. Rakesh, it was a pleasure chatting with you. Thanks so very much for joining us. Appreciate you taking out the time. So there you have it. I mean, the cycle's still in a downturn. Don't see near-term visibility changing much from these metal names. But like he said, companies which are on the path to improving their debt scenario on the books are likely at the top of his list?
JSPL, Angul plant coming up, and they're talking about deleveraging. That's probably the only one that is doing that. Anyway, Jess, that's all the lowdown on the metal space. Before we wrap up, onto a Bloomberg Quint exclusive. MSMEs need capital at reasonable rates, says the country's principal economic advisor, Sanjeev Sanyal. Speaking to Ira Duggal, he admits that SMEs have had to bear the consequences of series of policy changes, be it GST or the government's demonetization drive, which sucked out cash in the system. Listen into a small slice of that conversation.
There are various issues. First of all is that the channels of credit to the SME sector, first because of the banking sector slowing down credit, and now more recently with the NBFC sector. So there is a channel issue. But even more perhaps problematic has been the fact that credit, when it does reach, is very, very expensive. So in the last several years, you've seen structural inflation decline for 8 to 10% range to now for the 4% range. In fact, sometime right now running even lower. So when you have reduced structural inflation by 600, 700 basis points, then you have to think about the fact of what happened to the lending rate. But on the other hand, SMEs are still borrowing at between 10 and 12%. Now, if you're borrowing at 12% and pricing power in the system is growing only at 4%, that is a 800 basis point real interest rate. So we have to understand that at 800 basis point real interest rate is very, very expensive for anybody. And so this is an issue that we now need to, as a country, not just the central bank or the MOF, but as a country, we need to think about the cost of capital, because in the end, the cost of capital does feed through to not just competitiveness of our manufacturing, but also to the sustainability and stress of the system. Conventional economists tend to only look at the demand impact of interest rates, whereas interest rates also have a supply side impact. They have a risk impact on the financial system. So all of these are issues we need to think about. So making cheaper capital available where it is needed for the SME sector is an absolutely critical thing that we need to think about.
Let me ask you for a view on whether you think a forbearance for SME restructuring would be advisable.
See, there are many things we need to do. So one of the things that, there is a short-term issue about monetary policy, about the current institutions that exist, and there is the larger issue of credit delivery to this sector at a time where we have indeed carried down this massive structural shift in inflation pressures in the system, and also in, dramatic tightening in the last few years of our credit institutions and so on. So, the fact is that we need to get institutional support, make sure the credit reaches where it does at a price that is reasonable to this sector. We cannot just have the same format we had before. So it's a sector that did go through some disruption as a result of many changes that happened, including introduction of GST and so on. And so now the time has come that we are on the end of this cycle, that we then support this sector and give them the benefits of going through all this disruption and change. After all, what was the purpose for everybody to lower inflation? So that we can lower interest rates as well. Now we need to take step 2.
Well, with that, it's a wrap on this leg of Indian Open on a note that the markets are lying absolutely flat. From Devina and me and the team that put this show together, thanks so much for watching.
It's not about the award. It never is. It's about what went before and what came after.
It's about getting recognized for the trust and confidence the customer has shown on us. We actually